Hey everyone, how you guys doing?
Great.
Great to have you, Dr. Murphy. Wayne, it's nice to have you on stage as well. Seems like we have Liz connecting here. And yeah, so let's kick things off here. George, I believe what you need to do is give X access to your microphone, but as George figures that out, we're going to kick things off here with our co-host, Dr. Robert Murphy. I'm Jackson Blau, Head of Community Management here at Infineo, and we're bringing you our weekly Twitter Spaces. This week, our topic is cash management with whole life insurance with Infineo experts, where we're going to dive into, as the title tells, cash management with whole life insurance, also known as infinite banking, what that means, how to get started with it, and looking at our own experts' lives and how they've implemented it themselves. And so we're really excited to have our co-host here, Chief Economist, Dr. Robert Murphy, and our Infineo experts, Wayne, Liz, and George. And we're going to get George up on stage here. But while I work on that, Dr. Murphy, do you want to dive in a little deeper to the topic?
Yeah, sure thing. So thanks everybody for joining us. We're, of course, recording all of these. And so we're going to take the time here on the front end for this first one to just give a little bit of background, but we promise we'll be brief and get right into the content very quickly in terms of the meat of it. So yeah, my name's Robert Murphy. I'm an economist here at Infineo. I am not directly in life insurance production. Our other panelists are, and that's largely what we're going to focus on, just for them to give their expertise and wisdom from their experience in doing so. But I have a long history with the infinite banking concept. And before we get too much into our personal bios here, let me just say something at the outset as far as the terminology. So we're going to probably in these sessions, and these are going to alternate, we're going to probably do these like every other week or so in terms of the devotion to this particular topic for the Infineo's Twitter Spaces or X Spaces, as you prefer. And so we're probably going to be interchangeably using the terms infinite banking, or what we say here at Infineo is cash management with whole life. And infinite banking, it goes back to something that Nelson Nash developed called the infinite banking concept. All of us are steeped in that tradition. We knew him personally. He's no longer with us. And so, we want to always pay homage to him as being the inventor and discoverer of this concept by using that terminology. On the other hand, though, at Infineo, we're doing our thing, and, we don't want to confuse people as to, there's different approaches and different philosophies. So that's why, strictly speaking, what we brand it at Infineo is cash management with whole life. And we also think that term is a bit more informative to, the newcomer who doesn't know what the heck this thing is. So that's just a note on the nomenclature. In my background, I was an academic economist. Many of you may know me. I'm from the Austrian School of Economics. Carlos Lara introduced me to the work of Nelson Nash many years ago. And then we helped, along with Nelson and his son-in-law, David Stearns, formed what was called the Nelson Nash Institute and set up a training program. Cole Snell, the founder of Infineo, was a graduate of that program. A lot of the people that, are going to be coming and going as experts as the series moves forward are also graduates of that program. And so, there's a lot of rich history there. But at this point, yes, I serve as the chief economist here at Infineo, just making sure that the way we're trying to explain to the public the actuarial mechanics of how whole life policies work, how does infinite banking work, is sound and compliant with industry and regulation. So that's kind of my role here. I'm going to act more as a moderator or as a co-host with Jackson on these discussions because we want to share the wisdom of our panelists here. So with that, I'll turn it over if we want to go around the panel and just give a brief bio so people know, like, why should we listen to you guys when we talk about this topic?
So Liz, if you want to start, that'd be great.
Thanks, Jackson. So my name's Liz. I am based in Canada, and I have been using this process of cash management with whole life for a long time now in my own life. And after I was about a year into using it, I came sort of to it from frustrations with, thinking there must be a better solution than just what I was doing with investing. And I came across this concept and then started using it myself. And then after about a year into that, I was just amazed at how it was changing my financial trajectory and wanted to teach other people about it. And so I've been doing that ever since, and obviously, really enjoy working with people in educating them and helping them understand how this concept can apply to their own personal situations. So working with business owners, investors, families, on how to effectively use whole life insurance as cash management strategy in their businesses and personal lives.
That's incredible, Liz. Thank you so much for that in-depth description and background. I'm going to, as Liz said, this is really meant to be an educational forum. So if you have questions, I'm going to pin a tweet right now where you can put some questions for our experts that we will work into the conversation. And with that, Wayne, it'd be great if you could introduce yourself to the audience.
Thanks, Jackson. My name is Wayne Durksen. I'm from Saskatoon, Saskatchewan. I've been in the industry since about 1995 and probably spent most of my career misunderstanding the value of a properly structured participating dividend-paying whole life insurance policy. And many years ago, I met Nelson Nash, and he made a very profound statement, and it was simply this: you need to speak less and listen more. And so as I began to listen to Nelson explain what we're actually doing with the properly structured policy and how it advantages my own economic system, but that also of my family and bloodline, I became a convinced adherent and have pursued this, and I'm now helping many, many clients figure out how to change the flow of their capital and putting it inside a structure that they own and control, and basically preserving and protecting their capital to seize upon opportunities and learn how to keep wealth inside their own system. And so that was kind of my story, and I love what we're doing and how we're helping clients, and my clients bless me every day as I watch them use their structures to advantage their own wealth building system.
Incredible, Wayne. Thanks for sharing that. And with that, that brings us to our last speaker. That's for last, as they say. George.
All right. Hi, everybody. You can hear me okay?
Yes, we can.
Okay, awesome. Thank you. Yeah, so I've been in the insurance industry for 15 years, and I discovered the infinite banking concept about 13 years ago, and then I implemented it in our lives, my wife and I, and our family, and then I've been teaching it ever since. So it's one of those things where once you understand and learn and discover, you can't keep it to yourself. You have to share it with others. So I've been doing that for the last 13 years. And, my family, we have 13 policies, and we practice this every day, and I teach it every day. So it captured my entrepreneurial spirit, my purpose to serve others. And, I had the honor and privilege of learning directly from Nelson himself, the creator of this concept. And I've just loved every minute of it. And I could talk about this for days and days and days, but I won't. Thank you very much. Thanks for being here, and thank you for having me.
Great. Well, we're honored to have such an incredible panel of speakers to talk cash management with whole life insurance, also known as infinite banking. And with that, I think it's time we dive right into the conversation. Don't you say, Dr. Murphy?
Yeah, I think so. So let me just clarify or explain for the listeners who are joining us here. So we're facing a trade-off that there's going to be some people who are new to this that they may know some of us just from other realms, and they're joining this. Then they're curious as to what it is. So we can't leave them behind. We can't just jump into the nitty-gritty. By the other hand, we do want this to be a forum as we meet, every other week on this going forward. To be able to delve into some of the controversies even that are raging right now in the IBC community, and, to have our experts weigh in on those different issues. So we're going to try with every episode to keep a blend where, regardless of your background and level of expertise in this topic already, you're going to get something from this. That's our goal for what we're going to try to provide for you. So having said all that, I think probably the appropriate thing is to kick it off and just have our experienced practitioners here just explain when you meet somebody for the first day, they're like, hey, what do you do, or what are you into? Like, how do you, starting from zero, give your quick explanation as to, what the heck is infinite banking?
I'll jump in, and then George can add to it. But basically, I like to ask people if they understand the flow of money, that it's always in motion, whether you see it or don't see it, understand it or don't understand it, believe it or don't believe it. Money's always in motion. And the question is money flowing towards you or away from you? And that's really the premise. I start to have conversation with clients. And then I'm a bit of a stickler on understanding that our cash and our capital actually serve different purposes. And so I would say to clients, a good structure is an alternative storage facility for your capital until you find an opportunity you want to seize upon to build and grow and preserve and protect your wealth. And so that would kind of be one of my starting blocks for talking to a client about infinite banking or cash flow management.
So maybe we can take a step back here and even just look at a step further. Before someone would even potentially be a client interested in infinite banking, what would you say to someone that you're just meeting for the first time and they want to know what you do, and they're just asking, what do you do day to day? How would you explain that and truly kind of go into what infinite banking is without knowing anything, or without knowing that the client is motivated already for financial freedom?
Yeah, I'm not sure my answer would be much different, Jackson. I think I would ask people, whether they have a wealth building strategy that's working for them. Are they satisfied? Are they happy with what they're currently doing? Because what I do is I help people understand the flow of cash and capital, and then I help them begin to build a structure and a strategy to be able to leverage it and use it and benefit themselves and their loved ones long term, and change it from the traditional system to a very unique self-driven system that benefits and advantages them and takes them out of the rat race.
I just think that's so interesting, Wayne, and I love how you do that. I just think it's really interesting specifically that you don't mention life insurance in that first little explanation. Is that intentional, or is that because you feel that it's easier to explain what you do without necessarily explaining life insurance, because there's so many misconceptions and most often people just jump to term life insurance?
Yeah, I'm a big believer in effective questions, and I think we need to have good questions, and we need to get people to think. And one of my favorite Einstein quotes is 5% of people think, 10% of people think that they think, and 85% of people would rather die than think. And I'm not sure why that 85% of people struggle to invest the energy and the time to think, but you really have to take control. And so to me, it's about asking them good questions. Are you happy with what you're currently doing? Would you be interested in understanding an alternative way to store capital to seize upon opportunities? Those are questions that I think a lot of people go, I don't really know what you mean. Can you explain that to me? And with time, we get to actually lead them to a target to say, does that seem sort of exciting? And then we slowly understand the mechanics. And I often relate it to a vehicle. We all drive cars, but many people don't understand a transmission. They don't understand an engine. They don't understand ignition, but they still drive their car. And I think this is very similar. Let's not major on the minors until we're ready to really understand what's happening. And once people say, boy, I'd be interested in understanding what you're talking about, storing and preserving capital and cash flow until we find an opportunity to seize upon. Once people start to ask questions, we can begin to say, okay, now we can get a little more into the mechanics. But on the front end, I'm just asking them that they're satisfied with their system, and would they be open in understanding a better way to store capital and preserve wealth until the future.
And I think, on top of that, apologize if my voice is a little breaking up today. The importance of people understanding that they're either paying interest or giving up the ability to earn interest on everything that they do. So that's one of the fundamental concepts, and going through with people, sort of to your point, Jackson, about bringing it back to basics of what are people currently doing with their money. So when I sit with clients, they have the misfortune of getting to see me draw, and I often show them what their a current typical flow of how money's going through. and how could we flow it differently to create a different result. And then also, to your point, is talk about the benefits of using a life insurance contract go beyond, because we've also got that level of protection, because it is an insurance solution. So their family is also protected in addition to what else we're talking about, which is the living benefits of being able to use the whole life policy. George, maybe you want to add to that?
Yeah. So one of the ways that I like to explain it is, so infinite banking, cash management with whole life insurance, is a strategy. It's a concept. It's actually a way of life. And the tool that we use to implement that is participating dividend paying whole life insurance. So that is the vehicle that gets us where we want to go. That is the tool. And then how we use it is up to you. So the possibilities are infinite. And the other thing that people don't understand is this vehicle that we choose, participating whole life insurance, it is an asset. So it is an asset that grows equity, and then we are able to leverage that equity, and then we can purchase more assets that are also going to grow in equity and can provide an income. And on top of all that, we get lifelong protection for our loved ones. And this is all done in a very tax-advantaged way. And life insurance proceeds are always 100% tax-free. So when you talk about all the advantages and the pros and cons of this strategy and this vehicle, the advantages are incredible. The disadvantages are you just have to be disciplined. It has to become your way of life and your way of thinking. And really, it's infinite. The possibilities are infinite. Nelson called it the infinite banking concept on purpose for a very good reason. It is not finite. It is infinite. We are setting up a bank in the sense of, we put snow in a snow bank. We put blood in a blood bank. So that's the essence of our internal financial banking. And it's a concept, right? It's a way of life. So those are kinds of the ways that I would explain it to people.
Yeah, this is great stuff, guys. I think maybe it occurred to me, I can ask you guys a question that will perhaps cater to both the novice and the expert listeners, whether they're joining us live right now or listening to this later after the recording. So people who are listening right now, they've gathered thus far, okay, this has something to do with whole life insurance. It's a cash management vehicle, as George just said. Okay, the reason Nelson said it's a banking concept, it's not because it's literally a bank in terms of, the regulatory, the regulated body and such, but rather it's a place where you can put cash in and then access it when the need arises. And there's plenty of advantages to doing it in this way. But can each of you speak? What if you get somebody who asks you, why are you insisting that I use a whole life policy to do this? Like I go on the internet, I go on YouTube, and I see people showing me all the kinds of cool things I can do. For example, with an IUL, an indexed universal life, and they tell me, matter of factly, that whatever you can do with a whole life, this thing is better because you get the stock market appreciation as well. So I'm just wondering if you guys could comment on that, if you encounter that kind of question, and if so, how do you handle it?
Thanks, Bob. Yeah, great question. I think, one thing I speak to often around this is saying, the important attributes of whole life insurance. So one of them is the guarantees that it comes with. So we're not looking for this to be anything but a foundational asset, something that you can use with everything else that you're doing. So it's something in addition to the other things that you're doing. So what we want as our foundational asset is something that's very solid, has guarantees, and does not rely on market fluctuations or other things that could sort of cause issues with your finances. So you want to have these guarantees. So one of the attributes of whole life insurance is that it's guaranteed to grow every single day. And that's really, really important, as we're quite aware in this current environment, to have a foundational asset while other things in your portfolio are going up and down is very, very powerful. It just gives you choices and options in terms of being able to leverage the liquidity out of the policy and also knowing that that layer of protection is available as well. So having that, and, you know, I'll let some other people speak to some of the other attributes, but things like, you know, consistent premiums, regardless of age or health status changing, things like that are also really important components when putting together this solution.
Yeah, I'll just pipe in there. So Nelson always taught whole life is the by far the best vehicle. So any vehicle can be used to implement the concept, but by far whole life insurance, properly designed, participating whole life insurance is by far the best choice. Because, as Liz mentioned, of the guarantees. So the premium is guaranteed never to go up. The cash value is guaranteed to always go up. And the death benefit is guaranteed to be there for your entire life. And when done correctly, so it's the guaranteed foundation that is so important, and it provides liquidity and control. Big difference between whole life and universal life. So whole life, the insurance company takes on all the risk. They provide us a guarantee, and they take the risk, and they have to provide that guarantee. Universal life puts the risk on us because we are putting our money into the marketplace. Anytime we invest, we're doing so with the risk of loss. So this is not an investment, and it's important for people to understand that this is not an investment. And when you're comparing this concept and this vehicle with an investment, you have to make sure that you're comparing apples to apples, which a lot of times people are not doing. And Dr. Murphy has written articles on this very topic and explains it very well. So that's kind of the reason why whole life. It's for the guarantees, and it takes away the risk from us and puts it on the insurance company.
If I can add to that, I think George mentioned earlier that this is an asset, and properly structured policies are possibly the best asset you can own inside your portfolio. And what it will allow you to do has already been spoken to, but Don Blanton provided this illustration called the 10-minute lesson on life insurance. And in 10 minutes, we can start to look at what are the qualities and attributes of a properly structured policy versus alternatives. And I'm going, it's staggering to sort of look at how this structure was designed almost 200 years ago with very few changes since inception. And it still provides us a great place to store capital that actually has a competitive rate of return inside it, even though, as George just mentioned, this is not an investment. It's an alternative place to store capital until you see an opportunity to seize upon. And if you don't have good opportunities, you do have ongoing consistent expenses like your taxes or like your other bills, insurance, utilities, mortgage. There's all kinds of needs. But if you're an entrepreneur that's looking for new opportunities, they're really endless. And this structure allows you a highly tax efficient manner in which to manage your cash flow and benefit your own wealth building system.
Yeah, this is great stuff, you guys and lady. Let me just mention a couple of points here to clarify. So one thing is all of the stuff we're talking about here, we've got articles. If you go to the Infineo website, folks, if you want to learn more, so that's infineo.ai is the main site, and there's related ones as well. If you can go and get, there's, you can see headers for articles and such, and we talk about a lot of these issues. And so, yeah, one clarification that I want to make is that Nelson always stressed, he said, look, it's not that I'm advising you to invest in whole life insurance. As opposed to someone like, oh, you could go into gold, you could go into real estate, you could go into stock. That no, this was more like the headquarters for your money. And, he has a separate book called The Warehouse of Your Wealth, right? So the idea was, among other things, you can access the cash value in a whole life policy before you turn 59 and a half. If we're talking about people in the U.S. where you're plowing money into tax qualified retirement plans, there's significant penalties if you want to use it early. So the idea is if you see a parcel of real estate that you think is a steal, it's not that, oh, shoot, I took this Nelson Nash guy's advice and I put all my money in a whole life policy, so now I can't go into real estate. No, the whole point is it keeps you nimble. It allows you to do things like that. Also, in terms, I forget which one of our panelists mentioned it, but somebody said, in principle, you could do infinite banking with other types of insurance products. In fact, you could do some version of it, as Gary North pointed out, and he was a critic. So he's no longer with us, but he was a famous member of the Austrian School of Economics, and he famously did not care for, to put it mildly, this procedure. And he wrote a critique once that I thought actually was a good platform to show why infinite banking makes perfect sense. And what North said is, okay, yes, these people who are doing this, yes, the basic premise is okay as far as it goes, that you're building up wealth in this asset against which you can borrow. And he said, yeah, there's nothing wrong with that. But the fact they're saying you should do it with a whole life policy, again, this guy Gary North alleged, shows they're just trying to sell you life insurance. Because, hey, you could go do that with a house, for example. If you have a lot of equity in your house and your daughter's getting married, you could just go to your local banker and say, can I take out, home equity loan against my house? You take out the whatever it is, $30,000 or whatever, and, you go pay for your daughter's wedding, and then you pay the loan off. And he said, so it's the same principle. You don't need to use a whole life policy as the chassis for that. And so my observation was, I've written a lot and given talks on this, was to say, no, just think through the logic of it. And there's a huge difference between those two approaches, because if you try to borrow from a conventional bank, like against your house, they're going to run a credit check. They're going to see what your sources of income are. They're going to ask you, what are you doing? What do you want the loan for? What's the payback schedule? Whereas if you have a whole life policy and you say to the carrier, yes, what's my cash value, as long as it's over what the amount you want to borrow, and then you say, I'd like to borrow that, please, as a policy loan, they send you the money, no questions asked. They don't care what you're using it for. They don't care what your income is. They don't run your credit score. They don't even care if you make payments on the loan. It just rolls over at the interest rate that that's contractually specified. And so that, when people first hear that, they say, what are you talking about? Like, how can that be? And the difference is because the collateral. Ultimately, if you don't pay the bank back on your home equity loan, they have to evict you and foreclose, sell the house, pay themselves back, and then give you whatever's left over. That's a cumbersome process. Even if the loan was way over collateralized when it began, the real estate market could crash, and so maybe it's not as solid a loan as they thought. They don't want to have to call the sheriff to kick some single mother out of her house. That's awful. You don't want to go through all that. It's a pain to sell a house. In contrast with a whole life policy loan, the collateral is the cash value of the policy. So from the carrier's point of view, if you, quote, never pay it back, they just wait. You either surrender the policy or the insured dies, one of the two, at which point whatever is owed, they just pay themselves the loan back plus accumulated interest, then give the net, either to the owner if it's surrendered or to the beneficiaries if it's a death. So it's a subtraction problem. That's simple as cake. And that's why on the front end, they don't care. They say, yeah, you want to take out a policy loan? There you go. So even the critics actually set up to show why Nelson picking a whole life policy is the vehicle upon which one practices infinite banking was such a great choice. So with that, Jackson, do you want to maybe set us up for a different topic here?
Yeah, I'd love to, Dr. Murphy. Just listening to you talk about cash management with whole life insurance and just the way it sets you up for a really stable financial future is really incredible. And I know I'm sitting on the stage right now with 4 people that practice this in their own lives and have seen real benefits. And I'm just really curious if you guys could speak to what actually prompted you to get started infinite banking and managing your cash with whole life insurance policies. What was going on in your life and what were the actual first steps that you took for the listeners?
Well, I think for myself, as I said, Nelson, when I first met Nelson, he sort of suggested that I needed to speak less and listen more, and I might learn what this is about. And it did take me some time because I'm not that smart. But once I started to figure it out and I realized, hold it a second, I can preserve capital and use it again and again and again without interrupting compounding interest. So on a practical level, one of the things my wife and I did is we set up what we call our Phoenix Fund. We built a policy specifically designed to take us to Phoenix and golf every winter. And we've been doing that for years and years now. And we'll head down to Phoenix again this winter and I'll get 30 rounds of golf in, all through a policy structured strategy whereby we can repeat this process over and over and over until our health prohibits us to go without interrupting our compounding. So our wealth grows while we're actually doing something we love to do. And that was a big impetus to get me started in wanting to tell the world about this.
I know for me, when my wife and I discovered this concept and how it worked, we immediately implemented it in our lives, and we started with policies right away, and then I just started sharing it as much as I could. So I have 2 adult children. They're both married, and I have 2 grandchildren. So I mentioned earlier that we have 13 policies. Well, we have 13 policies on multiple lives with multiple owners, and they all have their own purpose. So I know without a doubt that my kids and my grandkids are going to be set for life. They're not going to have any financial concerns whatsoever. Don't tell them that, by the way. So that multi-generational wealth creation and transfer was a huge, huge thing for me. I know that I can set this up. It's going to benefit my wife and I while we're alive. It's going to benefit our kids while they're alive. And it's going to benefit our grandkids. And then that snowball effect of multi-generational wealth transfer is just going to grow and grow and grow. And the next generation beyond us is going to be set for life. I mean, the Rockefeller family has done this for decades and centuries. The wealthy do this all the time. The tax-free wealth transfer is incredible. And nowhere else can you do this. And the wealthy have been doing this for hundreds of years. So it's not that it's a new concept or a new vehicle. It's been around for hundreds of years. It's just, it took Nelson to put it all together and put it into practice. And then he wrote books about it. And then we're just trying to teach as many people as we possibly can.
Thanks. Yeah, as I mentioned at the start, I really came to this through my own frustration with what was happening with what I was doing with investing. So I was back then doing quite a bit of buy and hold sort of real estate investing. And I really thought that, there would be a way that my money could be working harder, sort of deposits I'm putting down on properties. And fortunately, actually quite by chance stumbled across this and really was excited about the possibility here because I didn't have to choose whether I would invest or implement this strategy. I was able to do both. And really, the concept of getting my money multitasking. So that, it was growing in a steady, guaranteed way. And then I could still continue to invest in however I wanted to. And so as I've used this over time, I've really learnt how powerful it is in a range of different scenarios beyond the one that I was first interested in. And like George, have also got policies on my children and just the ability to pass on intergenerational wealth is huge. And I think also really important for me is building a second source of liquidity. So it's something that I see quite often with investors is they have a portfolio, but it's not super liquid. So having an asset that provides that level of liquidity, which gives them then more options in terms of what they can do and how they can access their assets is really, really powerful in terms of how they manage their cash and just the level of protection it provides for their families and passing on that intergenerational wealth in a tax-advantaged way really changes how those assets can be passed on and as George alluded to, building wealth across generations.
Those are incredible insights, guys. Thank you so much. And seriously, I feel like everyone in this world is looking for their own version of a Phoenix Fund, Wayne, and I'm sure Liz and George and Dr. Murphy yourself, you all have different examples of that. And thank you for the listeners showing us a great example of how to get started from your personal experience. And so now I'd love to kind of just talk about a lot of people I see get hung up on the base versus PUA split when they're creating the policy. And maybe just for the listeners, we could actually explain what base versus PUA is and then why people debate this and then what your guys' opinion on this split actually is, if you guys have an opinion on the matter.
Sure, I'll always give my opinion. I just like to kind of reiterate a little bit of what Liz, before I get to that, what Liz said about liquidity and how important this is. So a lot of people want to compare this with an investment, which I earlier said is not the right thing to do. This is not an investment. So when you think about putting money away in an investment, you're locking your money in jail, and it has to stay there in order for it to grow. So how do you actually grow it and use it at the same time? Very, very difficult. With whole life insurance, you get to do both. You get to grow it and use it. It's liquid. That is so, so key to the whole concept. So you get to do multiple things with your dollar. Nowhere else can you do that. And you get to do it in a tax efficient manner. So, and then the other thing is, so if you want to use your money that you're investing or saving in whatever vehicle you choose, you tend to have to withdraw it, right? So once you withdraw your money from your investment or your savings, it's now gone and it can't grow for you anymore. So what is the cost of doing that? What is the opportunity cost that you have now created for you for your entire life and then every generation thereafter? So if you think about that, it's an enormous impact. So liquidity and the use of our money is enormous. And then the question about the base versus PUA, so paid up additions, so paid up additional insurance. So with whole life, we have the opportunity to put money in more than we actually have to, and it's optional. And every dollar that we put in that's extra goes towards purchasing more insurance, called paid up additions, fully paid for. And then those chunks of insurance that we're growing are going to, in the future, earn us dividends. So as participating policy owners, we are owners of the company or the fund, depending on how the company is structured. And based on the profits, we get dividends. And those dividends are tax-free when we reinvest them by purchasing more insurance. So compounding growth that we are never going to interrupt is an incredible factor along with the liquidity. So those two things make this vehicle the perfect vehicle to implement this strategy. And how we proportion those dollars really depends on the situation. So for me, there's never one size fits all. There's never I'm going to do this 10-90, 40-60, 50-50. I never go into dealing with the client on that basis. I always look at their situation, what they want to achieve, what are their objectives, what is their cash flow, how can we implement this the best way for them? So there's never a one way and there's never a cookie cutter way.
I think building on what George just said is that we have to understand the objective of the client. And then the question I love to ask people is the thing you're about to do going to lead you closer to or further from your primary objective? And so once that's been established, to me, I just say, let's just do the math. Let's run some scenarios and let's take this out. Time is your friend when it comes to finance. And so, to wealth building. And so I love to sit down and understand the client's objective and then build scenarios to say, there's a number of different ways we can get there. But look at the advantages to this way, or look at the advantages to that way, and then continue to allow the client to inform the process. Because at the end of the day, this is their strategy, this is their process, this is their lives and their bloodline that they're actually trying to serve. And so I say, just do the math and understanding how to structure this, design this policy. I mean, I'm there to serve as a bit of an expert and say, here are a number of ways, but I'm all about let's do the math and see what the outcomes look like projected down the way a little bit.
Yeah, great stuff, folks. If let me just chime in here too. So again, for the listeners, I'm not directly involved in production myself. But I'm an economist who kind of gets out of the hood with these things and tries to sort of rationalize or explain. If I see agents who have more experience in the trenches, if they explain things, that I try to take what I'm hearing from all the different sources and codify it and distill it down and just make sure, like, okay, is this what we're saying? That's kind of the role I play over the years in this space. So let me try to just kind of give a broad overview. So again, what we're talking about here is, as I think George was the one to first lay out, the idea being that, okay, given that you're going to have a whole life policy and you're going to pay whatever it is, $1,000 a month into it, there's another choice you can make, which is to say, does that $1,000 consist of what's called the base premium, or is some of it just the base and the rest is to what's that paid up additions rider that George explained? Okay, and then briefly, big picture, kind of the trade-off there is for a given dollar contribution in the base side, that gets you more death benefit, other things equal, but not as much cash value. Whereas the more you turn the dial in terms of the $1,000 a month or whatever it is that I'm putting in, if it's like 60% PUA, then you're going to see the cash value build up more quickly, especially in the early years. But the amount of death benefit you're getting for agreeing to the insurance carrier, this is what I plan on doing, is lower. And the intuition there is, if it's a PUA rider, as the term suggests, it's a rider, you don't have to exercise it. And so that's why, it's like, let's say it's $1,000 premium, but it's 40% base, 60% PUA. You have the contractual right as the client to just go to paying $400 a month on that base premium, right? So that's why you're not getting so much face death benefit on the PUA part, because you're not on the hook to have to make those payments for the next 60 years or whatever. So they're not going to guarantee you a bunch of death benefit because they don't know if you're actually going to choose to elect that option. Okay, so that's kind of what's going on. And so then the question that's raging right now in the broader infinite banking community is there like a cutoff at which point, it wouldn't be responsible, it wouldn't be a good policy design, it wouldn't be consistent with the principles of infinite banking to, dial it so far one way that it's like, usually the people that say like 1090s, like, does it make sense to have a policy that's 10% base, 90% PUA? And there's a difference of opinion from people who, on both sides have a lot of experience in this area. So just real quickly, just to kind of summarize the dispute, as I understand it, is the people saying, no, you don't want to do that for your clients. One of their main arguments is to say, because if you do design the policy that way, once you get well into it, like 10, 15 years down the road, the client's not going to be able to put as much money into it because of the regulatory treatment. We don't need to get into that right now, but that's the quick answer. And so they're going to say the client's going to be mad at you 10, 15 years from now. Once they see how this thing works and performs, they're going to be very pleasantly surprised. And then 15 years into it, they're going to say, why didn't you coach me better? Now this thing's kind of like sealed up. I can't put more money into this, and I'm upset with you. And maybe my health has changed, so I can't just take out another policy on myself now. Okay, so that's kind of where the people who say don't turn the dial so much that way. On the other hand, the proponents are saying, no, there's plenty of clients, like business owners or whatever, that maybe they just have like a window where they have a large cash flow, they want to fund this thing, and then they want to move on to a different asset to fund that or whatever, or they just want a limited commitment. They don't want to be on the hook for 60 years to fund this thing. And so for that kind of a client, the fact that you can zoom a bunch of money into it for, 8 years, and then it trickles off as to what you're on the hook for, that's actually a feature. So anyway, that's kind of the trade-off. I'm just curious, for our panelists here, does any of that resonate with you? Because again, I'm not in production myself. It's not that I have clients that I've set up a policy with and then 10 years down the road, they give me feedback. So I'm just wondering if any of that resonates with you guys.
Yeah, I think that's
yeah, Dr. Murphy, that makes perfect sense. And that's exactly what I'm saying is it depends on the client, right? So it totally depends on the client, their circumstances, their objectives, their cash flow, what they want to achieve, what their timelines are. So there's definitely, in my mind, no one size fits all. It really depends. So sometimes a 1090 makes sense. Sometimes a 4060 makes sense. It just depends, right? And for me, there's no right or wrong. It just depends on the situation.
I think it's a conversation that needs to come up more when advisors are talking to clients. Certainly, we can't predict the future. But human behavior is actually a very big component to this in terms of understanding what is the client likely to be able to do and fund and for how long. And what is, because the guarantees are going to happen. The policy, as you said, is going to have its limits based on how it's funded. And so it's important to take all of these factors into consideration when looking at it. And so, I wouldn't ever say that one split between base and PUA would fit every single person. But there are certain circumstances like that, a business owner, as you said, or an individual who's funding it, that over time are going to create quite different results based on what the person themselves is likely to do in terms of how they fund it. So that the human behavior component of it really needs to be brought into this debate more, I think, rather than just the structure of the policy.
When you say human behavior, Lynn, and you're talking with potential clients or clients, are there potential behaviors that you're looking for in clients that will be successful with infinite banking? Or is it more the opposite? Like conversely, there are behaviors that you see where that people won't be successful with infinite banking?
I would say in general, this is not an overnight solution. So, talking to people about the, longer term nature of doing this, and consistency is really important. It's more, I think, having an open dialogue with people rather than making that assessment, just having an open dialogue with them. And actually, I visually also show people what changes based on what they choose to do and how it will look different, just so that they really understand with numbers in front of them the impact on their choices. So that's really what I mean, so that they understand, because they're able to predict their business or what they're going to do. They know their own situation, and just having that conversation with them so that they're actually going in making an informed choice with obviously our guidance about what is going to be the best solution for them. I think you're going to add something to that before, Wayne.
Yeah, I think one of the comparisons is engineering. Once we understand what the client's objective is, we go about designing or engineering as a structure that will serve them best. But a good engineer will always over-engineer their project, and we do the same thing inside a properly structured policy. Once we understand their objective, we're going to consider the options, and then we're going to over-engineer it so that it will actually be flexible while driving them towards their objective. And at the end of the day, it's absolutely delightful to be able to hear a client has a new, unexpected situation arise, and we're saying, yeah, we designed this, we actually over-engineered it. So now we've got flexibility and options, both for additional deposits as well as reduced deposits due to a season of life that's difficult. So again, there is no one size fits all, but it is our responsibility as advisors to know how to design and structure and engineer these policies for maximum impact.
Yeah, if I could just chime in on that as well. So again, I'm not in, I don't deal with the public directly one-on-one in terms of giving them policies, but, I've been privy to those conversations. And I think to underscore, you definitely, if for those listening, if you're curious about these types of things, you need to talk to an agent who knows how these work, right? And it seems like, oh yeah, of course you're just saying that, but as you can see, there's a lot of moving parts with these things, and there's a lot of subtleties involved. And so, unfortunately, what happens sometimes is, your buddy who sells life insurance that you've known since childhood says, oh yeah, I can give you one of those things, and he doesn't even know what he doesn't know. So it's not he's deliberately setting you up with a bad policy; he just doesn't know what he's doing when it comes to these things. So there's that element. But as Wayne just said, believe it or not, even with these sort of plain vanilla whole life policies, which is really what Nelson Nash always thought should be the vehicle, there is a lot of inbuilt flexibility. So just this issue we talked about, the base versus the PUA. So yes, if you're saying, oh yeah, I expect to be able to put in $1,000 a month, let's go ahead and design it that way, and let's say it's 60% PUA, 40% base. What that means, among other things, is if your business, you're a small business owner, or you're an employee and you get sick or whatever, or your child gets ill and you have higher medical expenses than you planned on, you can just automatically stop making those PUA contributions. So what you thought of as my monthly $1,000 expense, boom, goes down to $400 while you need it. Or if you've built up cash in the meantime, you can borrow against the policy to keep making the premium payments, right? So there's a lot of flexibility even with this, very old conservative vehicle. And so I think a lot of the public's misconceptions about this are just because they don't know how it works. And that's partly my own entry into this space is in the beginning, I didn't understand how whole life worked. And I would read the critics, but then the more research I did, their objections just kept falling away. So it doesn't prove that, the IB community was right, but I just realized most of the criticisms I've seen thrown against this concept it's just the person doesn't know what they're talking about. It's not just like, oh yeah, I quibble with it. It's like, no, they're just demonstrably wrong, especially, like big critics like Dave Ramsey or whatever, just the confidence when they say things that are just, no, they're not even close to being right. So again, that doesn't mean the infinite banking community is right, but it did kind of encourage me to keep researching it further. So I would say that too for anyone who's dipping their toe in the water on this stuff.
That's incredible insights there, Dr. Murphy. Thank you for that. And for everyone in the audience, if you do have any questions, we're coming up on time here, so you can leave those on the first pinned tweet. And I've also pinned a second tweet for everyone in case any of these topics that we're talking about, cash management with whole life insurance, also known as infinite banking, seems like something you'd be interested in implementing in your own lives. You can take the first steps by booking a call with our experts. We have both the Canadian link and the United States link in the pinned tweet. And so if that interests you, please schedule a call and our experts would be happy to walk you through and see how this could work in your own lives. And with that, I just want to move into one last topic to close us out here. And just with the amount of expertise and years in the industry we have in the room, one thing that's really interesting to me is kind of how infinite banking has evolved over the last 10 years. And not necessarily 10 years, just over time. We've seen a lot of different marketing ploys trying to get people to utilize infinite banking, potentially in scenarios where they shouldn't. And I'm just curious how you guys have seen the evolution of infinite banking in recent years and how you hope it continues to evolve in the years to come.
Well, I can chime in real fast on that, and I'm curious to hear what everyone else has to say. But with me, it kind of mirrors what happened with the term Austrian economics, believe it or not. That when I was in grad school, people called it career suicide to go into that. And then my joke was later, I said, now it's no longer suicide. It's just like cutting your arm off or something. but then when Ron Paul was running for, all of a sudden, like it became cool. And people were named, like, especially like people in the financial sector might, to appeal to a certain demographic, they might be throwing around, Austrian economics, even though they didn't really know what they were talking about. And so I saw a similar pattern with infinite banking that, there was a period when no one even knew what it was. And then there was, oh yeah, that's just a cranky thing. And, that's just silly. Don't do that. That's just for suckers. It's people's. And then all of a sudden it became huge. And you can go look at a chart of like how many times people have Googled the term infinite banking and it, just goes through the roof in recent years. So I've seen a similar thing like that. And then, so on the one hand, it's great that it's more popular, but then the downside is, there's a lot of people coming in and marketing who don't really know how it works, and it kind of gives a bad name, to others who are doing it the right way.
Is there anything specific? Sorry, George, I didn't mean to cut you off. I'd love to have you add back.
No worries. So yeah, I mean, I've been doing this for over 13 years, and I've seen the evolution, and it's becoming more and more popular because it just makes sense. So really, the issue is people don't know what they don't know, or they're getting misinformed. So there's a lot, as Dr. Murphy pointed out, there's a lot of people out there that are giving misinformation, or they'll know a little bit and then they'll come to a conclusion that really doesn't make sense and is not logical or correct. So we're fighting the misinformation, and we're fighting, the fact that people just don't know what they don't know. And, institutions do not want people to know this stuff because it's not to their benefit, right? So who is going to teach you and tell you and show you how this works? Well, it's people that have done it and know what they're doing. So that's very important. And as far as the future goes, I personally would love to see this be the norm, right? So this is the foundation, like Liz mentioned. This is the foundational piece that everyone incorporates into their life. And from this foundation, you grow and do what you want to do. If every child in North America had a policy put on them by their parents or grandparents as soon as they're born, this world would be a different place, right? Everyone would have that solid foundation that financials foundation and then the stewardship of that foundation, we would all be so much better off. So if we can just make this the norm instead of the exception, that would be incredible.
If I can chime in here, I'm a bit of a policy governance guy, and John Carver was the first one to write anything on policy governance, and he actually trademarked the name. And today we see the bookshelves are full of resources on governance, and everybody's trying to get their piece and write their marketing strategy to drive prospective clients. I think that's also evident in this realm as well, and people are learning, and as George said, they've got a little bit of information and they come to really insane conclusions, but they're writing with a little bit of knowledge, and I'm saying, boy, you need to do the homework. When these are structured properly, advisors actually get far less return out of them, commission out of them, when they're structured properly. And so when people are writing and the market's being flooded with new resources and new presenters, I'm saying make sure you do the homework to get a properly structured that it will actually serve you well into the future, and not just the sale of a product. It's a process, not a product.
Thank you for those insights, George and Wayne, and Liz prior. This has been a really, really incredible space, guys. Really honored to share the stage with you guys and talk infinite banking or cash management with whole life insurance, as we call it at Infineo. And with that, we're coming right up on time here. And so, as I said at the beginning, we hold these Twitter spaces every Tuesday. We alternate topics between digital assets and cash management with whole life insurance. So next Tuesday, we're going to be on talking tokenization of real world assets with people in that space. And the following Tuesday, we'll be back on talking infinite banking again. If you'd like to fulfill that itch that is itching at the back of your head right now after listening to this conversation, all you have to do is click the first pinned tweet and book a call with one of our experienced agents, and they'll help you get a whole life policy set up in your life. They'll explore all the ins and outs and make sure it's customized just to you, as we've explained on this Twitter space. So thank you, everyone, for being here. We look forward to seeing you on a consultation.
Thanks, folks.
Thanks, everybody.